Welcome back. We have a jam-packed video this evening. It's a special video on Sunday. We're going to go a little bit longer than usual because we're going to cover a wide variety of topics. That includes the economy, why I feel that we're headed towards a pause. And we're going to start with a recap of a SPY trade that was on Friday. That was for insider access. We're going to look at the economy, interest rates, what's going on, how the economy modulates in terms of rate and duration versus interest rates. We're going to look at some of the specific players within the markets and how the dichotomy of the markets are set up. Also, what we've seen from earnings and a bunch of underlying elements. One thing that I'm very proud of and that I believe in always doing is qualifying every word out of your mouth. If you can't qualify something, don't say it. There's no point. And we know that that's something that we do within insider access. That's something that I do on my Twitter feed. That's something I've done in my professional career. And not to give advice on careers, but to start off, that will serve you well your entire life. If you become known as someone who qualifies what they say, people will say that person is a serious person. They know what they're doing. They qualify it. And they don't try to hide in the gray. Don't try to hide in the gray. Don't be ambiguous. Don't be afraid of being right or wrong. So with that said, that's obviously paramount to trade ideas. So what do we have as a trade idea? We're going to do this quick recap and then we're going to get into the markets. For insiders, we had a trade idea that was on Friday. Obviously a massive move in the SPY, a dump off. There's never any hearsay, ambiguity, or nonsense. So I want to pull up this image that I was working with. And I posted this on Twitter as well. And this is from the 11th. That's on Thursday at 2:48. Said in no uncertain terms, if we see a gap up, I will be looking for an early dump off into volume on SPY. This was within Discord, right? So what did we see to the word? And let's take a look at it. You have to stand by what you say. So that was at about 2:48 p.m., right? It's in the afternoon. If we see a gap up, we start moving up, we head into the after hours, we gap up. This is called a gap up, right? We move from about 411, just under 412. We gap up over 414 at one point, and we open at about 413.50. So to the word, we see a gap off, and we will see an early dump off into SPY. I'll bring this image right back in here. And again, look at the date, 5/11/23. Insiders, I mean, I don't have to show it to you because it's all within Discord and nothing gets erased, nothing gets deleted. It's all there for everybody to see. So we get that gap up. I give a signal to the trade ID and I say, look, we're going to look to enter. If we can get up at 413.55, hit that entry point. Of course, it goes higher than that, but I call it out a little bit later and say, look, grab the momentum. We will grab the momentum on a reversal. Don't buy into this move up. And I put in a note when we saw this occur, don't buy into this. If it gets back up to 415, take another entry, get in. And if not, hit the reversal on the way down. And of course, this is pretty clear, self-explanatory. What the kids call the bang, what do you call them? I'm terrible with slang, and particularly insiders know this. Bangers. I always think of bangers and mash. It's food. But yes, the bangers. This is a banger. Terrible, right? But you don't come here for lessons in slang or to hear me discuss or try to use my terminologies correctly in slang, rather for what we saw. And of course, this wasn't something that was a weak call out or saying this could happen, this could happen, this could happen. I said, I'm looking for a gap up. We saw the gap up, and I'm looking for a sell-off into volume on the SPY. Here's the SPY, ton of volume, strong sell-off in the markets. And of course, we knew this in advance because we've been qualifying why this would occur all week long. We've been targeting in the range, and that's something that we do within insiders. And we're going to look at the overall markets, and it's not simple enough to just say, hey, take a look at the charts. Well, we've been ebb and flowing in this direction. Why wouldn't we hit to the peak and then reject? Again, it's something that I discussed in depth, and then we're going to tie this all into the markets and be able to circle back on the idea. But I just wanted to have a quick recap on the trade idea that was shared and share then say, look, this wasn't fly by the seat of our pants, Furu style. Oh, looks like it's setting up. Looks like it's not setting up. Always take caution listening to the talking heads. As you go along in this business, in this industry, in this endeavor of yours, for those of you who are not doing this professionally, those of you who are doing it professionally, of course, I always welcome you to listen to my insight. Just be aware of the talking heads and the misfits and those who try to say things that are sensational but can't qualify them and love to be ambiguous. Right? Ambiguity drives me wild, right? Because those are the people who want to be right all the time, but they don't want to say anything, and they always want to come back in hindsight, right? And you can see in politics and every facet of life. So these are people that I avoid and I don't appreciate the opinions of. qualified it day before, said we're going to hit a gap up. You can see it on a larger chart. Gap up, boom, sell off in volume. It cannot be more clear than that. And that ran for hundreds and hundreds of percentages. Don't need to flaunt that, because this is going to be a video that I believe I will be sharing, at least the first half of it, with the general public. So I'm not here to share that. You'll see the retweets, and I will praise everybody. We already do enough of that. So let's talk about the markets. What have we seen in the markets? If we're looking at the markets here and it's sideways, right? And this is a chart. This is the SPY, the S&P 500. This representative, this is ET on the S&P 500. I find that most people have higher affinity to the SPY because it's a trading vehicle. But of course, what are we looking at? Representation of the S&P 500 index. So I'll go back to the SPY since that is of high interest. And I find that if you can sort of target the things that are most interesting to people, it helps drive their focus on what they're doing. So of course we'll look at SPY, right? So what we've seen, we're seeing a little bit of a sideways range. What have we seen in the markets overall? Why do we think there might be a pause? What is going on with the underlying economy? Because what we saw in 2000 is everybody said, oh, where's the recession? Oh, where's the recession? I thought there was a recession coming. And then the recession hit like a bag of bricks. And this was very early, teenager days. Towards the end of those teenage days, we saw the markets absolutely crumbled, right? And I talk about that a lot, and I talk about the dangers of not understanding the macroeconomic environment, and we'll talk about that as well. But it also happened in 2008 in the financial crisis. The talking heads and the misfits, and these days they're just all over Twitter. Like, you just listen to some of these people. What is your background? What is your expertise? What are the things that you discuss, right? Are you always saying things like, oh, bro, it could go. This is a banger. I see a triangle setting up on an inverted axis on a 3D plane. Or are they looking at the underpinnings of the economy and what's actually going on? Do they have that experience? In 2008, it was the same. You heard people say, where's the recession? Where's the drop off? What's happening? And then all of a sudden, we saw a meltdown, right? And so things take time, and we're going to look at a few different charts. But the first thing I want to start with is you see a lot of constituents. You saw Microsoft do relatively well. Again, did they actually do well or not? Well, we'll talk about it in just a moment. Saw Apple, some of these names in Apple really just sold off from where it was and made a little bit of a move up. But the dichotomy of the market right now is such that we are not equally weighted. And that's something I want to dig into really quickly. So to give everybody a look, and this is something that I've shared within Insider Access before. So I'm going to bring this image over. And pardon me, I didn't have an opportunity to put this into the PowerPoint presentation that I typically would like to go with. So I'm just going to pull images here from one of my other screens. But the effect is the same. What do we see here? So I want to talk about this. You see the markets driving up, right? So we're going to look at SPY, and we've seen this move up recently, right? So this is the new year. Of course, we had a little bit of a pullback. We see a drive up, but what is that based on? Breadth is very important. What do I mean by that? Well, the SPY, S&P 500, is an aggregation of the 500 securities, right? So you would think when you see that it goes up, you would say, well, the markets are doing well because the SPY is doing well, and the SPY is a representation, or the QQQ, which is the NASDAQ, is a representation of the S&P 500. Therefore, those top companies are doing well, and thus the economy is doing well and is strong, right? Incorrect. That is mathematically not correct because it is too broad. And when you look at some of the closer details, first off, Apple and Microsoft now make up almost 14 or over 14%. And I've shared charts with this with insiders in the past as well. And recently, they're extremely heavily weighted, such that we have not seen two companies occupy that heavy a weighting for over 40 years. So that's something to keep in mind. Now let's look at the actual performance. It's a top heavy move. What I mean is the big strong players have moved up, but if you look at the index, it's not doing nearly as well as you might think. And this is from February 2nd, and I put this out on April 24th, and we've recently updated. Just haven't put it on chart format yet, but it hasn't changed a lot. So if you look at the top 50 companies, we're up 1.89%. But then when you expand to top 100%, to 100 companies, we're only up 0.49%. Now, if you look at the S&P 500 index, down 1.39%. If you look at it equal weighted, what do we mean by equal weighted? If you're not giving heavier weighting to Microsoft and Apple, which are disproportionately weighted to the index, we're actually down 6.7%. How are small businesses doing? And that's important. When you want to talk about the overall economy, you cannot overlook small businesses. Well, the Russell 2000 index, it's small cap. I'm not talking about mom and pop shops, but I'm talking about smaller cap where we break off the S&P 500. It gets worse. The lower you go, the worse it gets. The more heavily, the higher weighted. So we have about 20 names that are driving the markets right now. And a lot of that is on speculation and things like AI. And oh my God, AI is going to revolutionize the world and certainly will in time. But the top 50, yeah, it's very positive. And if you narrow in on a couple of securities, great. Yeah, big moves up. Top 100, not so hot. Overall index, not so hot. Equal weighted, exponentially worse. And then, of course, if you go to smaller caps, worse and worse and worse and worse. And that's important to know. So now we look at the markets and say, we've driven up, but it's been on low breadth. So how do we look at this quarter? What was this quarter? So in this quarter, we saw these earnings from Microsoft and Apple and a bunch of different companies. But if you look at actual earnings, I'm not talking about projections, right? Because there's a difference between projections and forecasts versus actual earnings. Earnings are down 3.7. They've declined 3.7% thus far. And we're not done quarter one earnings. There's still a few companies to come in. I think probably the biggest company that most people are waiting for would be NVIDIA. But we look at it, we're down 3.7%. Now, if you listen to the talking heads, here's where you're going to get misled. They'll tell you that 78% of companies thus far have beat their forecasts. And that's true. So when you hear that, you think, wow, that's bullish. How come the markets aren't breaking out? Okay, but we're down 3.7%. How do you beat forecasts yet be down? Well, here's what happens. As we put out forecasts saying, well, the markets are going to be down 5%, right? And then we come in at 3.7%, down 3.7%, and say, hey, the markets beat projections. That's what happens. We had significant downgrades, and I've gone over this in detail with insiders on a bunch of different occasions. We had significant downgrades across the board, almost any company you can look at. And those companies didn't do well, but they didn't do as poorly as expected. Think of this. I want you to think of this when you're investing your money, because it's important. And I want everybody to respect their money and not be reckless. And one of the reasons that I dig into these details is I want you to look at this as a professional, as an investor. If you're a business person and you've run a business, what I'm going to say here is going to really resonate. If you are in decline, you have somebody managing your business and they come back to you and say, we lost money this quarter, right? You can say, what the heck's going on? They say, hey, but I thought we were going to lose a lot more. Is that going to be a positive to you? Or is that going to be a negative to you? You're going to be upset. It's not good. And they say, well, we're projecting to lose even more money next quarter, but we might beat forecasts and we might not lose as much. We should celebrate. The value of your company isn't going to go up. You're not going to be happy with that, right? Of course. So it's the same thing here. So we had a 3.7% decline thus far, and we have a few names yet to come in, but it won't change substantially because the vast majority of the S&P 500 has reported in. And across the S&P 500, we have a 3.7% decline in earnings. That puts us in an earnings recession because we have multiple quarters now of earnings receding, declining, okay? So when you hear the talking heads, what they're going to celebrate, or people who are what we call perma bulls, and I call that madness. You should not be a perma bull or a perma bear. You shouldn't be a perma anything. You should be looking, analyzing, looking at data, because there are periods where we see a bullish market and we see declines. And the only way that you can ascertain when it's appropriate to invest or make moves is to read in between. What do we expect for quarter two? Well, we're looking at 7.3%. So this quarter that we're in right now, right? So quarter two is AMJ. So it's April, May, June. The quarter we are in now is expected to be down 7.3%. So if we come in at minus 6% from minus 3.7 this quarter, they're going to say, oh, we beat forecasts again. Oh, how exciting. We're doing better at failing than we expected. We're not failing as badly as we expected. So when we talk about the impact on the economy, these are the things that we look at. We are in an earnings recession. That is what an earnings recession is. This isn't profits taken. This isn't Peter Tarr's opinion. This isn't Peter Tarr, his fund or his cohort or his people or whatever you want to say, his opinion. These are the realities. We are in an earnings recession because earnings have receded. They have contracted. That is what recession is. And normally, in other days, I wouldn't have to explain this, but I know I'm speaking in retail and you get a lot of noise, including official statements from the White House of reclassifying what a recession is. Good. Set it aside. I'll concede that ground and say, you know what? I don't really care what you say. I mean, you could tell me the sky is pink and reclassify blue to pink. I'm still going to look at it and say, yeah, whatever, call it whatever you want. It's the color that it was last year and the year before that has been for my entire life. So this is how the game is played on Wall Street, is that you have these overly negative forecasts, and then companies come in ahead of them and they say, oh, they beat forecasts. And then you wonder, well, if we beat forecasts and we came in positively, why is the market declining? Well, because sales are going down. And when I talked to you about it just moments ago, I said, if you had a business of your own, right, think of this as your own business. How are you going to feel? So when you're a shareholder, it's the same thing. Do you want to see your company losing money? Do you care that they beat forecasts? Of course, there's a lot of context to take in. You have to look at projections and guidance. But remember, this is important. We are forecasting another decline. That's going to be 3 quarters. We're forecasting 7.3. To go 3.7 to 7.3, even if we beat that, is very negative. Now, we know that it's a top-heavy market, and those top-heavy names are the last to fall, typically, right, as stocks. So they're propping up the markets right now. Names like, well, look at the moves we've seen from Apple, right? That's an enormous move. Enormous move up. Microsoft, even bigger. And these are the 2 most heavily weighted names. And as I said earlier, we have not seen 2 names occupy that level of weighting within the S&P 500 since the 70s. And look at this enormous move up on Microsoft, right? We had lows, and this is the beginning of 23. So we're talking about what it's done this year. Down to 219 to 308 for a company the size of Microsoft is amazing. Nothing short of just, it's staggering. From a market cap perspective, that is an enormous move, okay? Now, when you think about the economy and why the Feds might pause, because remember, we're going to circle back on this, we want to look at a few things. Let's look at some of the weakening on the economy, because one of the things people will say, well, jobs are not softening, so the Fed. This is very important now. I want people to understand something. At this point, if you speak to any professional worth their salt, and I don't mean the talking heads on NBC or Fox or news or whatever it is, and I certainly don't mean the guys in Twitter who had some random job a few weeks ago but realized they could con everybody and throw some guesses out and make some money on the side. If you talk to anybody who's respectable and isn't just parroting what other people say, they will explain to you that it takes time. So when we look at the SPY, right, the damage is already done. The damage is already done. And I'm going to give 2 important comparisons and analogies here, right? Work with math. So if you look at multipliers, I'm going to put this in simple terms. I'm not going to use the sort of professional terminology, nor am I going to use mathematical terminology. If we have 2 numbers, right, and we have a multiplier that is time and one is rate. So let's say we have a rate of 3% for 1 year, right? You don't need to keep raising, and let's say the output is pressure. You don't need to keep raising a rate in order to apply more pressure. Time will do that. So with the Feds at approximately 5%, right? At a 5% rate, if that is the Fed fund rate, let's just say that's what interest rates are, and it's going to vary. I'm not talking about what you get from the banks. You don't need to keep raising it in order to create more pressure, but people have been hypnotized into that, or rather, they're inexperienced and they listen to the media a lot and they listen to people who don't know what they're talking about and don't understand basic math, because you get so caught up in, is it pivot? Is it raise? Is it hike? Is it slash? Or are we ready to cut rates? And they just say, okay, well, the Feds have to keep raising because wages are high and employment is high. And we're going to address that in just a moment. I have some charts here. No, you don't. That's not how it works. Simple math. Anybody who understands compound interest understands that. So I'm going to show you something. This is what I call rate versus time, right? And I like to use this, and I give this presentation to the kids in the family. You can tell how boring I am. What a great uncle, right? You could talk video games with them. I'm talking to them about stocks, trying to help them understand. So this is a chart of Emily and David on compound interest. All else is equal here. This is just the effect of time alone. Emily starts at 25, Dave starts at 35. They have the same rate. The only variable here that is different is time. And look at, as we move along the graph, Emily is double Dave on the same rate because time has played its role, right? So this is just a simple breakdown of math. I know that some people might be have a high affinity for mathematics. Some people might have a low. So if you have a high affinity, please excuse this. You still understand it conceptually. If you're not a fan of math, this just makes it really easy. This is the same thing with the Feds, only the Feds have been raising the rate exponentially, right? So you don't need to keep raising the rate because there's no change in rate here, but look at the difference in impact, right? Now think of this as weight on the economy. This is what's happening every day. It's more weight. It's more weight. And as time goes up, notice how the slope becomes, the trajectory becomes greater, right? We go from like a 45 degree to 60 degree to 70 degree. We're almost parabolic, going 90. It becomes immense, the weight and pressure on the economy. So do we need to keep raising rates? No, time will do that. And I'm going to give two analogies here just to make this really clear. The first analogy is, imagine a family who has costs a run rate of $5,000 a month and they have $50,000 in the bank. They have 10 months, right? 5 months, $5,000 per month, $50,000 in the bank. You have 10 months to live off of. Now, if the idea was to put them in a dire position, not that we want that to happen, families, and you wait a month and you say, oh, they're not homeless yet. Oh, we need to raise rates because it's not going to happen. No, it's going to happen. They've got 9 months of savings. Just wait. It's going to happen. Do we then say we need to raise it to like $10,000? No, because what that's going to do is you're not only crushing that family now you're going to crush families who could afford $5,000 a month, who could afford 6, 7, or 8, but they can't afford 10. And what's going to happen is the impact is going to be substantial. So I always go back to the pie baking idea, right? So we know that I put up a graph of baking a pie and a pumpkin pie. So here's what it was. If you start a pie on time, let's say that we need a pie, otherwise people are going to starve, right? If you don't cook the pie, people will starve. If it's undercooked and it's not ready, people will starve. So we need to save lives. We need to finish cooking this pie. What you're supposed to do is start with enough time so that people don't get to the point of starving. The Feds didn't do that. They botched, right? That was the transitory inflation period. They messed it up completely. So what they've been doing is they've been turning up the temperature so as to say, well, we need to get this pie out as fast as possible. Let's crank up the temperature. But similarly to a pie, you don't just keep turning it up and saying this is what we need, because it takes time. Now, if you ask any economist, it's typically 12 to 16 months that you look for impact. We moved our numbers up because of high savings to 14 to 18. So we expect the real impact, peak impact, to start hitting at about 16 months. But remember, rates have continued to go up over time with the Fed. So we're only about 1 year, we're 14 months removed from the first rate hike. That's a small rate hike. We're about 1 year removed from the next big one that was in May. Every day that we go forward, we're feeling the impact of rate hikes that hit the system. Like last month's rate hike is going to have its full impact hit next year. So it's just adding weight. You don't need to add that weight. But we get back to the pie analogy. If you need to have a pie baked, you can't simply say, well, I messed up and I didn't heat the oven up in time. So I'm going to set this pie to 1,000 degrees. That way I can get it ready because I have guests showing up now. The only thing that's going to do is burn the pie and perhaps burn your house down at the same time. Not that you can find the standard oven that hits 1,000 degrees, but you're just going to burn it. If you set it too low, then of course the pie never gets cooked and people starve. That's the idea of inflation keeps running and it damages the economy. That's when it's too low. People starve. If you set it too high, you burn the pie and nobody gets to eat. And what did the Fed do? Well, they're just going to print more money. And essentially that's the idea of, we messed up the pie, we're just going to go out and buy a new pie. That's the idea of printing money. And if you're a concerned investor, you'd say, you donkeys, why didn't you just tell me that in the first place? We could have just bought a pie then. Why'd you have to mess around? Why do we have to go spend money on these ingredients? So that's the pie analogy. That's why I think that the Fed is going to start to pull back. But some of the things we look at, again, I want to qualify all of this. Well, we say, yeah, but jobs. Again, you're listening to the news too much. And this is not to say that it's impossible for the Feds. I put it out on Twitter and I said, I think the Feds are done. I think they're done. We're going to be done next cycle. At the next FOMC, we're going to hear a pause. But again, that doesn't mean that it's positive, and I don't want people to misunderstand. It's been gamified and oversimplified because Twitter is dominated with just endless accounts of people who have zero knowledge of economics, have zero knowledge or experience within the markets. right? So let's take a look. How are things going on the job front? Well, you hear week over week and it sort of shakes you. Oh, we had a high report and a low report and a high low report. Within Insiders, I always explain, don't worry about the nonsense day to day unless it's something absolutely mind-blowing and staggering. So let's take a look at initial jobless claims. This is what we're seeing week over week. How does that look? Look at the trend line. And I plotted a trend line here, right? Look at the graph. If you were to look at this and zoom in, you can get lost in this week to this week and this week to this week, right? It can happen. I completely understand. And that's what happens when you're listening to the headlines. If you look at the trend, where are we going? The trend is extremely clear. But I also explain to insiders, to anybody who wants to listen as well, and I want to help everybody have a better understanding. I don't care, whether you're an insider, whether you're not. I obviously go a lot deeper, and at the end of this video, we're going to cut off and I'm going to move to insiders only to talk about some other ideas, but I want everybody to understand so you could better plan, prepare yourself for yourself, your families, and have a better understanding of what's going on in the economy. This is a clear trend line, right? And the only thing you shouldn't only look at initial jobless claims because there can be anomalies week over week, even with a long trend line. So what do you really look at? What matters? It's just like the idea of forecast versus actual earnings. What actually matters more? Actual earnings. Okay? You could play games with the numbers because forecasts are modulated by who? Analysts. Who cares? You're an analyst, you have an opinion. I've done in-depth explanations. We've looked at Bloomberg and the way analysts work. This is something for everybody to know. Here's a little bit of secret, the inside on Wall Street. You look at any security and you look at the spectrum of analysts, it is so wide, it is mind-blowing. You can pull up Apple and you'll have some that we have a target of 220. You'll have some that say we have a target of 130. You pull up NVIDIA, we have a target of 345. We have a target of 190. The spectrum is over 100% more often than not, and this is on S&P 500 companies. So you have to separate signal from noise, otherwise you may as well just say I trade the 9 EMA or whatever nonsense signal and easy to package, easy to sell idea there is. Let's take a look at continuing jobless claims because that's what's really important, right? This is the overall employment. If you look at new initial jobless claims, that tells you the acceleration, but we could accelerate, decelerate. What's the speed? What's the overall number? What does unemployment look like? And the big indicators that we could read into, of course, there's the unemployment number, but continuing jobless claims. And remember, they revise these and they play games with these numbers and dress them up. And then they won't tell you that a lot of the jobs that were lost are white collar, the highest earning jobs, and some of them are lower earning jobs. Let's just look at continuing. How's this trend line? And we plotted 2 log trend lines with different calculations. You can see both of them. This is as up as it gets. If you were trading this as a stock, you'd say this is a clear uptrend, right? The amount of jobless claims, continuing jobless claims, are on the rise. That means fewer people who are exiting are able to find jobs. What does that tell you? Well, it's also a class item, right? It speaks to that idea that, we've got 1.9 jobs for every person. Sure. But I don't think an executive at an accounting firm is really interested in being the expediter at the Starbucks drive-thru. Not that there's anything wrong with an honest living at Starbucks or anywhere else, which is where a lot of these Twitter furrows were 2 weeks before they figured out they could run a scam on Discord or on Twitter. There's nothing wrong with that, but people not re-entering the workforce isn't because they're rich and there's, we have deflation and everything is cheap. Oftentimes what happens is you can't find something that is appropriate. So rather than use up your time to go take a greeter position at Target when you used to be an executive within an accounting firm, you stay on the sidelines, you'll collect your unemployment for as long as you can, and then you'll keep looking for a job because the calculation is, look, if I take on a job at a fraction of the salary that doesn't employ my talents, instead of looking for a job, I'm now working something that'll take away my time. So there's a cost to your time of taking a job that is sort of beneath the standard that you've set for yourself and what you are worth in the markets. So that's our continuing jobless claims. And another item that we have, and we've talked about this as well, is the idea of the US government is now pulling in less money. So as the rates go up, we have a higher burden, right? We know that the budget surplus has fallen. The US government is able to collect less money from taxes because there's less corporate earnings, collect less money from individuals. Why less money from individuals? Well, people are losing jobs. That's not entirely it. But as equities go down, right, as we've seen this happen to the S&P 500, not everybody's fully invested in just a few of these names. This is still down a tremendous amount. If you look at it for this year, on the way up, what are you getting here? You're getting a lot of capital gains, right? Because above people's salaries, everybody invested in mutual funds and everybody invested in stocks and cashing out and making money. Lots of revenue for capital gains. What are you seeing here? You're actually seeing the opposite. People are now able to deduct against their taxes. Of course, you're capped and you're limited. It's unlimited when it's capital gains. It's tightly limited when it's capital losses. But there's no capital gains. That's the big issue. There's losses. So that's less money for the government to collect. And so the high interest rates are putting a strain on them as well. And even if we look at things like XLK, right? XLF, a lot of these are down. So XLF, this is financials, is down. Even that, we see banks are still in distress. Now, a lot of people look at one name, JPM, and say, well, JPM seems like it's doing well. It's the only name. They're often the last to fall, right? And you've seen a little bit of a pullback in recent days. How's Wells Fargo doing, right? Not so great. How about Bank of America? Not looking so hot, right? So it's not that banks are fine and banks are all resilient and a lot of them are sitting near or at their 52-week lows. So we're seeing stress there as well. And so we see pressure on the US markets. Obviously, we're hitting a debt ceiling. Now, the one thing that we can say when I talk about the government collecting less taxes and having issues with the budget surplus, which has fallen, of course, the one caveat there is the government isn't like a company. A company tends to just go bankruptcy and go out of business because they have to play by reality, right? Free money helps them out and low interest rate loans. Companies can get by and get more shareholder dollars, and there's all sorts of things, but they shut down when they don't perform, when they mess up. What does our government do? What do most governments do? They do this quantitative easing thing, right? This is a fancy term for nonsense. It's called printing money and making up your own money when you don't have enough money. Imagine if we could all do that. Hey, I was going to buy a house for $9 million. I don't have $9 million in the bank. I'll just go hit the printer, print it out, and we'll figure it out. We'll figure it out, right? This is what's happening when we raise the debt ceiling, or an easier way to think of it is just an unlimited credit card where you can raise the limit. You get to decide. You're the person spending, but you're also the person who gets to decide on the limit. You don't have to go to a credit card company. You just have left a little negotiation within your own cohort. That is the left and the right, or Republicans, Democrats, or all these other people talking. And say, no, we want to keep spending. We want to keep spending more. Maybe you should cut back on spending and balance a budget. No. Maybe you can't afford to do all these things that you think you do. No, I could print money. Okay. Well, that's called printing inflation. So if you think of it differently, you'll know what it really is when they print money. It's called printing inflation, devaluing the currency, printing inflation, having more costs, higher costs. Those costs have to go to somebody. So who pays the cost? Taxpayer. So when we talk about why we feel that the feds have done their job, well, we have a clear trend on initial job claims. We have a clear trend on continuing unemployment claims. And that's without the brunt of interest rate hikes impacting the markets yet. How about on corporate earnings? How about on earnings? How about on things that will impact jobs, right? Because what impacts jobs? Well, how well a company's doing. If a company doesn't have money, it can't have employees. It starts to fire employees, lay them off rather, right? Okay, well, how are the companies doing? Well, we now have projections of minus 7.3%. We're in an earnings recession. There's a clear defined official, not Peter Tarr, but this is a earnings recession in multiple quarters, and we are projected to see a steeper and deeper earnings recession. Now, the markets will react differently, but this steers us towards a recession, a global recession. And when I say that now, I just mean one that even the White House or politicians can't deny, right? You can't parse it any way. We start seeing unemployment rise, you see corporations losing money, we see the GDP contracting, which we are seeing, the GDP is contracting. I don't know what weird silver lining they can make up, and I don't really concern myself because I dislike politicians in general and the way that they play games, because I never care about you. It's just about what can we say and make up to get votes. And I mean this for all of them. So I don't really care about that. That doesn't mean anything. I just look and say, okay, well, again, you can say the sky is pink. I'm going to look out the window and say, yeah, looks blue to me, but sure, we'll call it pink if you want. Earnings are falling, GDP is falling, unemployment is rising, initial claims rising, continuing claims rising, banks are under stress. And the important part about the rates when we talk about that is every day adds more pressure, because remember, it's time. So if you think the only way to push the economy down is to increase rates. No, it's not. That's like saying the only way to make more money on compound interest if the interest rate rises. That's not true. You just wait longer. That's not even close to true. That's actually crazy talk, right? Here you go. Interest rate's not rising. The amount of money's rising because of time. You don't have to rise the rate. It just keeps going more and more, and it gets heavier as it goes along, right? So you don't have to raise the rate. So I think this is a cutoff for the public. The last note I will make is that I do think we'll have a pop, and when we're trading and a lot of the ideas I share, it doesn't mean that we're always in range. We break, right? So be careful with that. This doesn't mean that this is a surefire range, and there are reasons we break up into it and the reasons we break down into it. I'd like to discuss and go in depth with that. We're going to talk about Amazon. We're going to talk about Google. We're going to talk about a lot of pair trades coming right up for insiders. But to everybody else, thank you for taking a listen in. I hope this was informative, that this can better prepare you and your families and your investing strategy and help you get a different view, and maybe just, if anything else, tune out a lot of the noise that you hear. Feel free to independently research everything that I've discussed here. Of course, the more informed you are, the better. Earnings are estimated at a 3.7% decline. We still have a few names to report in. NVIDIA is a big name, and we're projected to see an approximately minus 7.3% decline. Feel free to look at the trends when you graph it out, of course, on initial jobless claims, and GDP. Whatever you'd like, the more that informs you. But I hope this really helps everybody out, gives you a better understanding of the economy, of economics, where we are, and how rates really impact the economy. And now what we're seeing, because remember, for everything I said that we had a 12 to 18 month, that's 12 to 16 is the typical for rate impact. We expanded our model out to 14, 18 just due to savings and what we felt might be an easier move for a lot of different companies and individuals. Remember, we are now at month 14 off the first rate hike, right? And then the second and the third, and it was a rapid, remember, we moved rapidly. So by quarter three, by the time we're hitting summer or Q4, we will have then gone through the brunt of high interest rates. So if we're already seeing this much pain and damage already, if we continue, it will be very problematic. And my saying that the Feds are going to pause doesn't mean that they're going to immediately cut. And we need to see a lot of pain. I maintain, as I've explained to insiders, that the Feds will have an emergency cut. They will cut because they have to cut. And I've said this from the onset. I was very early, one of the very, very first, and everybody knows this, and this is part of what grew my channel, is I was emphatic and clear and no nonsense, said we are heading into a bear market. When did I say this? At the peak, when everybody was so happy and jubilant, and I think it was January 12th we dated it too, right? This is where I said it, where everybody was so happy, you're crazy, you're a fool, look, we've been on an upward trajectory, hasn't even gone down yet, this is where we are. What are you talking about? Yeah? Well, this is where we are now, right? And so the other thing that I've said, and I will stick to this, is that we expect it later in the year, might come sooner, might come a little bit later, so let's just say late Q3, early Q4, so we could push by one quarter. The Feds will cut because they have to cut, not because they necessarily wanted to, because they're going to overcook the economy. That way we can have the economy rallying come elections, because of course they are responsible to political forces. And when you have a boss, in this case, the Fed, Jerome Powell, has a boss. He has somebody who can hire and fire him. We'll see a cut later in the year. And I've been consistent with that messaging, the same as I was consistent as heading into the bear market. So thank you everybody for listening in. Insiders, stay tuned. We're going to go a little bit deeper here.